Okay, Kent, thank you so much for being here with us today. Are there any projects or anything exciting you're working on at the moment that you want to share with us?
Well, let me tell you about something we're doing. I am the executive director of the McCoy College Foundation here at Texas State. And one of the really exciting things that we're working on right now is our second strategic plan for the foundation. So that strategic plan ties in with the college's strategic plan and goals, as well as the universities. So it's a whole lot of fun for us to sit down and think of creative ways that we can support the students and the faculty and staff in the college, and how we can grow the assets of the foundation so that we can have a bigger impact. We just completed our very first strategic plan. And so it's a lot of fun to look back and see what we've accomplished, and then to be able to build on that. So we're having a lot of fun with it. And, I really would encourage everyone, if you haven't had that opportunity to participate in a strategic planning process, find an organization and do it. Or if you haven't done one for your business, that's a great opportunity for your business, is to develop a strategic plan. Get some colleagues together or associates or mentors and sit down and chart your path for the next few years. I think you would find that process very, very rewarding.
Thank you. Okay, we will now begin the webinar. Hello, everybody. Thank you for joining us for our 8th webinar of the Entrepreneur Bootcamp webinar series. We're so excited to have you here today. Our topic will be the basics of fundraising, and it will be facilitated by Kent Hamilton. I would also like to introduce myself and our team. My name is Ariel, and I'll be the monitor for today. We also have our translator, Rocio, and our technical support person, Sachet. During this webinar, you will be able to ask questions. In order to do that, you can use the Q&A button at the bottom of your screen and type in any questions you have. This webinar is provided under a grant from the Texas Workforce Commission, Workforce Solutions Rural Capital Area, and the Service Learning Excellence Program at Texas State University. Kent, again, thank you so much for being a part of this series, and I will now hand this over to you.
Thank you. It is my pleasure to be here today with you. Can't wait to get started and talk about fundraising for your business. But before we jump in to something, I want to give you a disclaimer. While we are going to be talking about a lot of financial information, we're going to be touching on some legal issues as well. I want you to know that I am not an attorney or a certified financial advisor. So if I'm not one of those things, what am I? Well, I have been a professional fundraiser for over 20 years. And during that time, I have raised in excess of $100 million, primarily supporting higher education and also health and human services. So it is such a rewarding profession. I enjoy it so very, very much. But you might be thinking, what would someone like me be doing talking to you about fundraising for your business? Well, I will tell you that much of what I have learned over these last 20 plus years is directly translatable to your situation. So I feel that I can provide some value and insight to you as you go along the path and you determine at that exact right time that you need to raise some excess dollars to grow your business. So why are we here today, and exactly what is our goal? So the reason we are here is so that you can walk away with a better understanding of the fundraising process, some of the things that are involved in different types of fundraising, and then what to do once you get that money. But our goal is for you to walk away having the confidence that you can do this, that you will be able to set your own path and follow the process to raise money to grow your business. That is our goal today. So what are we going to talk about in our time together? The first thing we're going to do is to review some terms that are pretty common in fundraising for your business. Now, I'm going to say this now, and I will say it again. I don't think the expectation is that you would want to walk away from here with a memorized understanding of every single component of each of these. Some are pretty easy. Some have a few more technicalities to them. I think it's more important for you to have a general understanding, know when it might be necessary to use one of these things. And then, of course, you can always do some of your own research to get better acquainted with them. So once we've gone through that, we're going to look at what are some of the potential sources for funding for your business and how are they appropriate in different situations. Of course, then once we've identified who it is that we're going to ask, then how do we get prepared to ask? And then what do we do once we have the money? So that's our plan for today. And of course, as I said, if you have questions along the way, please feel free to type those into the Q&A box, and we'll get to those as soon as we get through the material. So let's get started with terminology. So like I said, lots of different terms that we're going to cover today. But the first one is, what is a term sheet? So a term sheet is going to outline the very key and material terms for your funding. Very, very important. It's primarily used during the proposal and negotiation phase. And once it is agreed upon, it's going to give the attorneys or other professionals who will draft and complete all the legal documents any necessary information that they need. So exactly what is this? So a term sheet is a non-binding agreement that sets forth the basic terms and conditions under which an investment will be made in your business. They're most often associated with a startup. So entrepreneurs find that this document is crucial to attracting investors who most often will be venture capitalists who have the available capital to fund their enterprise. So what would be included in a term sheet? The valuation of your company, the amount of the investment, the percentage of stake sought, voting rights, liquidation preference, anti-dilutive provisions, investor commitment. Those are just some of the key items that would be spelled out in your term sheet. And though a term sheet is very different from a letter of intent or a memorandum of understanding, I want to bring those up because sometimes you may hear those terms referenced interchangeably in casual conversation. They can accomplish similar goals, and they often contain some very similar information. So just important for you to know that there's a slight difference in those three things. So let's move on now. What is equity? So we all hear that word in a variety of contexts. So equity, quite simply, is the ownership percentage in your company. So if we think about equity as a big puzzle, the investor wants to know, well, how many pieces of that puzzle do I own and what is it worth? So the ownership percentage in your company, very simple. So let's move on to a capitalization table. Some people will just refer to this as a cap table. It's the exact same thing. And it's just simply a ledger that's going to keep track of all the equity holders in your company. Quite simple. So this capitalization table is going to show each investor's equity capital stake in the business, which is calculated by multiplying the share price by the number of shares owned. So in most cases, the names of the security owners will be listed on the y-axis and the types of securities on the x-axis. In addition, all of these holdings for each investor should be on a single row. Well, now that being said, how do you present this information? So it can be done in a variety of ways, and it really depends on your target audience. We are going to bring up target audience quite a few times during today's presentation. I can't emphasize enough of understanding your target audience, what drives them, what motivates them, and what do they need to be able to see in order to make a decision. This is just the first time we're going to mention that. So how can we set up one of these tables? So some capitalization tables may list investors by founders first, followed by executives, key employees, equity stakes, other investors such as angel investors, venture capital firms, or maybe others who are just involved in the business plan. Another way is the capitalization table may choose to list the investors in descending order by ownership. So the very largest ones will be at the top, moving down to the smallest ones at the bottom. But you know, one of the things that we can always agree on is that nothing stays the same. Change is a constant. And that's the same with companies. Companies are constantly evolving, and therefore your own capitalization table must continually be updated. For example, when a company sells new shares of an existing security or issues shares of a new security, maybe they increase the option pool or grant options to an employee, all of those things change the capitalization table. Likewise, terminating options when an employee leaves the business, or letting options expire, having an investor exercise vested options, or having an investor redeem, transfer, or sell shares are all things that are going to alter that particular table. So the bottom line is someone needs to be specifically charged with keeping the capitalization table up to date with changes that are occurring in the company. So let's move on from that and let's talk about fully diluted equity. So what is fully diluted equity? It is simply the ownership percentage, assuming that all issued shares are taken into consideration. Generally, the largest difference is shares in the stock option pool that have not been granted to eligible employees. So fully diluted shares are really important because they are going to give investors and markets a better idea of your company's actual value. That's really important. The meaning of fully diluted shares can actually vary depending on the context. It's often specifically defined in a contract. In the context of fundraising, though, which is why we're here today, fully diluted shares are commonly understood to encompass these things. So the issued and outstanding shares, that's common stock and preferred stock on an as converted to common stock basis. Shares that would be issued and outstanding if all outstanding stock options, warrants, and any other convertible instruments were exercised. And all shares that are reserved but not yet issued under the company's option pool. So that is a fairly good definition and understanding of fully diluted equity. Now that we have that, let's move on. Let's talk about what is the difference between common shares and preferred shares of stock. So really, one of the main differences from common stock is that preferred stock actually comes with no voting rights. Let's think about that. So when it comes time for a company maybe to elect a new board of directors or vote on any form of corporate policy, preferred shareholders have absolutely no voice in the future of that company. In fact, preferred stock functions actually similar to bonds. Since the preferred shares, investors are usually guaranteed a fixed dividend in perpetuity. Here's one thing that is advantageous, though, is a preferred shareholder has priority over a company's income, meaning that they are paid dividends before the common shareholders. So in a liquidation, preferred stockholders have a greater claim to a company's assets and earnings. This is true during the company's good times, when the company has excess cash and decides to distribute money to investors through dividends. The dividends for this type of stock are usually higher than those issued for common stock. And preferred stock will also get priority over common stock. So if a company misses a dividend payment, it must first pay any arrears to the preferred stockholders before paying out the common shareholders. And lastly, common stockholders are going to be very last in line to company assets, which means those assets will be paid out to creditors, bondholders, and preferred shareholders before those common stockholders are given any attention. So let's turn our attention now to valuation. So what is valuation? We hear that a lot, and it's really important as business owners to understand the definition of valuation. So this refers to the implied value of your company. So your company is only worth what others agree your company is worth. So valuation is a quantitative process of determining the fair value of an asset or firm. In general, the company can be valued on its own on an absolute basis or on a relative basis compared to other similar companies or assets. So there's several different methods, there's different techniques for arriving at the valuation, and each of those may produce a slightly different value. Valuations can quickly be impacted, as you can imagine, by corporate earnings, economic events that force analysts to retool those valuation methods. So we briefly touched on them, but let's go back and look at what are those two main categories of valuation methods. So the first, as we said, is the absolute valuation model. That attempts to find an intrinsic or very true investment based only on fundamentals. They're looking for the value based on fundamentals. And what that means is that you would focus on such things as dividends, cash flow, and the growth rate for a single company. You're not going to be concerned at all about any other companies. On the flip side of that, you have the relative valuation model. So when we're valuing a company with this model, we are really comparing that company in question to similar companies that we can find. So next, let's talk about a priced round. Sometimes they will call a priced round an equity round. So if you hear those two things, they're pretty much interchangeable. Simply put, though, it is a fundraising activity in which equity in your company is sold. For starters, a price round is an offering and sale of newly created stock in your company at an agreed upon per share price. So investors who buy these stocks become part owners of your company. So they have equity in your company, which is what we just learned about. Next, let's go to dilution. So dilution is any activity that would cause a reduction in a shareholder's equity. Sometimes not a very good thing. So when the number of shares outstanding increases, each existing stockholder owns a smaller or diluted percentage of the company, making each share less valuable. So imagine if we have a cake and that cake is our company. Dilution would be a case of cutting that cake into more pieces. So there certainly will be more pieces of cake, but each one is going to be smaller. So you still get your piece of cake, only it's smaller than you had been expecting, which is often not a desired outcome. So share dilution may happen anytime a company needs additional capital, seeing as new shares are issued on the public markets. The potential upside of share dilution is that the capital the company receives from selling additional shares can certainly improve the company's profitability and the value of its stock. So some of the causes of dilution might include we need to have more money raised, which means new shares are created. Maybe we need to create some new shares to make room for a co-founder in the company. Or maybe we are creating shares for a new employee stock option pool. So all of those could be reasons to lead to dilution of the stock. Now let's talk about the definition of an accredited investor. This is really important. Remember, we talked about target audience. So in specific instances and scenarios, an accredited investor may invest in your company. If you have that special case where you can look for an accredited investor, you need to understand how that is defined so that you are reaching the right audience. So an accredited investor is a person or a business entity who is allowed to deal in securities that may not be registered with financial authorities. They are entitled to such privileged access if they satisfy one or more requirements regarding income, net worth, asset size, governance status, or professional experience. In the US, the term is used by the Securities and Exchange Commission under Regulation D to refer to investors who are financially sophisticated and have a reduced need for the protection provided by regulatory disclosure filings. So accredited investors include natural, high net worth individuals, banks, insurance companies, brokers, and trusts. So I referred to this before, but I want to say it again. In the United States, the definition of an accredited investor is put forth by SEC in Rule 501 of Regulation D. Why do I want you to know that that is important? It's because if you have a scenario where you can look for an accredited investor, I'm going to suggest that you go to this document and review the current definition because it may change. So what I'm telling you today may or may not necessarily be true years from now. You want to make sure that the definition is consistent. So to be an accredited investor, a person must have an annual income that exceeds $200,000 or $300,000 if you're filing jointly for the last 2 years, with the expectation of earning the same or higher income in the current year. So the individual must have earned income above the thresholds, either alone or with a spouse, over the last 2 years. The income test cannot be satisfied by showing just 1 year of an individual's income and the next 2 years of joint income with a spouse. The exception to this rule is when a person is married within the period of conducting a test. So a person would also be considered an accredited investor if they have net worth exceeding $1 million, either individually or jointly with a spouse. The SEC also considers a person to be an accredited investor if they are a general partner, executive officer, director, or some related combination thereof for the issuer of the unregulated securities. An entity is an accredited investor if it is a private business development company or an organization with assets exceeding $5 million. Also, if an entity consists of equity owners who are accredited investors, the entity itself is an accredited investor. But important to note, an organization cannot be formed with the sole purpose of purchasing specific securities. So the last term that we want to review today is general solicitation. So general solicitation is pretty much exactly what it sounds like. It's advertising your fundraising activity via public forums. So basically what you're doing is you're just making it public that you're going to be fundraising for your business and trying to grow it. So we've gone through a lot. I understand it's a lot about these terms, some more technical than others, as we said, but just remember, what you want to do is have a working knowledge of the terms. You can always go back and do more research on your own as needed. But with that being said, let's turn our attention now to what are some of the potential sources of funding. So when do you start looking for investors? So my advice is early, today. get out there before you need any money at all. So start looking at the time you're starting your business. Get to know people. Go to an industry conference. Go to investor meetings. Introduce yourself to people. Ask for advice. Tell them that you are working on something so very exciting. But at this point in time, I would not mention that you're looking for money, so that when you come back later, it's now a warm introduction rather than a cold call. That can make all the difference in the world in fundraising. So we've talked about the particular importance of understanding your target audience. The next thing I really want to hit home with you is that fundraising is truly all about relationships. So you want to start building that network and those relationships right now. And once you've built them, it's up to you to maintain those relationships. So now, what are those potential sources of funding? The great news is there are several of them. But what is really important to understand as well is that based on your particular situation, some groups of potential funders may be more appropriate than others. So let's talk about who are those potential funders. So the first thing I would like for you to consider is yourself. So are you a potential source of funding for your business? I would always suggest that the first thing you consider is whether you need an investor at all. In fact, about 90% of new businesses start with something that's called bootstrapping. So what that means is that 90% of all businesses are going to start with just their own money. So you may start with your own money, but if you feel that you need investors or anticipate that you need investors, you have to do it in a very structured sequence. So what I mean by that is you would start with yourself, then look at friends and family. Then, of course, there could be angel investors and then venture capital investors. So a lot of people might think, oh, well, I think I need $5 million in order to launch my business. So I'm going directly to a venture capital firm. I'll get the $5 million all at once. I'm just going to warn you that it generally doesn't work like that. No one is probably going to invest if they think that you have no skin in the game. So most investors are going to ask for the money and ask how much did you put into this on your own. So once we've thought through the process of whether we ourselves can be an investor in our own business, let's talk about friends and family. You know, it depends on the amount that you need, but friends and family, you know, that's probably an ask of $50,000 or less. So traditionally, these are going to be people who invest in you very, very early. They're not necessarily looking for a prototype or a product. They're not asking to look at your customer base. They believe in you, and so you can go ask for small amounts. Now, this can be a little awkward, so don't be embarrassed to show financial statements, tax returns, or whatever else a family or friend might want to see to prove that you understand and know what you're doing. But if you're going to get money from a friend or a relative, I suggest that you get a loan, not an equity investment. That way you don't dilute your ownership if your business really takes off. I would also suggest to prepare a written agreement about a loan if that's what you do. If you don't, you run the risk of a bitter argument or maybe even souring that relationship altogether. You know, even a minor detail such as the timing of an interest payment could cause some friction if those arrangements aren't backed up in writing and done in advance. So what is our next source of potential funders? So I think a lot of people have heard of angel investors. So What is an angel investor? Those are people who invest their own money in your company. So in the amount that they might be willing to invest, maybe 25,000, 50,000, even 100,000. But at this level, these particular investors expect to see a prototype. They expect to see the dollars and the revenue for your company. They expect something, but they are not looking just at the product. They're looking at your entire business. So angel investors could have a very wide range of motivations and expectations. One angel investor may not necessarily be enough to finance your business. And angel investors could have a hidden cost, which could include tying up your valuable time, because some of them will perhaps want to get very involved in your business. So remember again, we talked about an angel investor might have a wide range of motivations and expectations. That goes back to understanding your target audience. You must understand them so you can talk to them appropriately about investing in your particular company. So at the very top end of our list of prospective funders would be venture capital. So you might have your business going, and at some point in time down the road, you might need $5 million, $10 million. That is certainly venture capital territory. So if you need a larger amount of money, certainly venture capital could be a good option. However, you need to be ready to justify your valuation, and certainly you're going to have to give up some equity. These people, though, will expect maybe a couple million in revenue and some good traction. They don't want to invest a small amount like $25,000. Most likely it's going to start at around $2 million or so. They're going to also expect a good bit of equity for that. So your valuation had better be up there. They may even want to put in their own management team to help you grow the business. So let's go back and think about this once again. When you consider potential funders, think of this. I'll start with myself, then I'll move on to friends and family, then angel investors, and even venture capital if I think that I'm going to need that much. But are those all the options that business owners have? And I would say in today's technological driven world, the answer is no. So you probably all heard of crowdfunding. So I think crowdfunding is a tremendous way to raise smaller amounts of money, especially for a consumer-oriented business. The fact is that crowdfunding is very, very popular. It's a great approach, and it's one that I would suggest you explore further. So this approach doesn't require much of anything out there. And there's multiple platforms that you can use. So in other words, you go out on the internet and you say, I need $50,000 for my business. And you are basically looking for people that have some faith in you and interest in what you want to do. The reason that it's such a great approach is that if you can get the money this way, you probably don't even have to give up any equity. On the other hand, if you get absolutely no interest at all, then maybe you should rethink your idea. So, like we said, this is not for large sums of money like trying to raise $1 million. Rather, this is multiple donors pitching in just a few dollars to collectively raise a smaller amount. And as we said, consider the industry. It may not be appropriate for all industries. I would say that crowdfunding is best for things that are consumer oriented because you can talk to a large number of people. You really need to research the type of business that you're building and if it would be appropriate for crowdfunding. But if it is, certainly do explore that. So now we have been armed with some terminology about fundraising for our business. We have also explored the potential funders and what they are looking for and what those levels are. So now that we've done that, let's get prepared. Probably one of the most important things that you can do is be prepared. So first of all, do I really need a business plan to show investors? And some people might tell you that you really don't. You don't need a business plan. They may say, why would you do it? Investors really aren't going to read it. I would suggest that this is wrong. You do need a business plan. Make sure that you have done your homework before meeting with any potential investor, even a family member or a friend. Even if that prospect does not read your business plan, what it does is it forces you to sit down and consider every single aspect of your business and have well-conceived and researched components. True, there are venture capital people who never read a business plan, and those are the ones who've been around a very long time. They're only going to deal with people who perhaps sold their last company for 800 million. They exclusively focus on people who are already successful. But if you're like most, and maybe this is your first entrepreneurial venture, you're going to need to convince people that you have understood and dealt with all the details of your business, such as how are you going to market your business? How do you incorporate your business? Who is your target market and how are you going to reach those people? These are all things that will be contained in your business plan. So yes, you do need a business plan. Now you need to have credibility. So this doesn't have to come from you. I think it's important that we can surround ourselves with people who can lend credibility and also serve as mentors to us. So in your business plan, you should probably talk about the top 3 executives in your company, like the CEO and founder, maybe the CFO, 2 or 3 advisors that are people that have equity, maybe not have equity, but are industry connections. So let me give you an example. If I were in the software business, I would love to have Bill Gates on my advisory team because Bill Gates immediately and instantly gives me credibility with my business. So, how much should I ask for? Well, do you ask for enough to last you forever? Do you ask enough to get you through a few months? So here's what I would say is a rule of thumb from industry. Look at the next 12 months, maybe the next 12 to 18 months. See how much you're going to need. And as a rule, don't ask for more than that. You don't want to lose control of your business, and asking for too much can scare away potential investors. So what you ask for determines how much of the business you need to give up. And so if you ask for $1 million and your business is worth $1 million or less, you basically just sold your whole business. What you ask for has to be meaningful, but not so much it scares those investors away. And when you are going to ask for an investment, you need to be prepared to explain, number one, what are you going to do with that investment? How are you going to spend it? I would be fairly detailed with that answer. Number two, how is your business functioning right now? How are your revenues? How are things going for you? And lastly, when might you anticipate your business running out of money? So for existing companies, the amount you should ask for really depends on your valuation. Your potential investors are going to judge your business based on your revenue, your customers, your intellectual property, and your profile. So let's say you don't have any revenue. Then they will probably ask, well, how many customers do you have? So if you have 1 million customers that are free, that's still something, so it might be worth $1 million. If you don't have either of those, do you have any intellectual property? So let's say you own a patent. Someone might give you $1 million in valuation just for holding that patent. But if you have none of the above, it's going to be all about you. So present yourself in the best light. Consider everything that you have done before. So have you sold your last company? Have you been successful? Have you been the CEO of a small company? If it is your first time, then your valuation is essentially zero. That means you probably can't get much money from investors, and you might be better off going back and talking to friends and family at that particular stage. Now, the next thing I'm going to say is practice. I cannot say that enough. You need to practice and practice and practice, and then practice some more. And after you've practiced, do it again. That's how important this step is. So practice your pitch to friends and associates over and over. It is important that don't come across like you've just memorized a speech, but you want to come across as very, very confident and the obvious leader of your business. You want to anticipate any potential questions that anyone might have. You want to have thoughtful and meaningful responses that speaks to the needs of your audience. So think through those questions, write them down, write out what your response would be. And if that response is different for different people, write those out. The other thing that is extremely important, anticipate why someone would tell you no. So you think you've done everything perfectly, you've prepared, you have asked the right person for the right amount of money, but they still say no. So go through every aspect of your business and anticipate why someone might say no, and then be able to respond to that. In fundraising, we always say that no doesn't always mean no. No might just mean not right now. So it's important to understand why someone is telling you no. But again, practice, practice, and practice some more. So now that we have the money, what are we going to do? So just because you secured the funding, and congratulations for that, that doesn't mean your fundraising job is over. In fact, I would say it's just the beginning. So remember that I said fundraising is really all about relationships. And now this is your time to shine. You need to keep your investors informed about your progress and your growth. If you've experienced a setback, that's great. Talk about it. What did you do? How did you respond to that? What was the result? In fundraising, we always say that your best prospect for a future gift is someone who has already given. The same is true with investors. If at some future point in time, you seek additional funding to help develop a new product or to grow your business, the people who invested with you the first time are your best prospects. And that is especially true depending upon how you managed that relationship. So we're going to take a few minutes and we're going to respond to some questions. But before we do that, I want to challenge you to do something, to do an exercise. So after we finish here, I want you to sit down with a cup of coffee. And remember when we talked about practicing, we talked about think about every aspect of your business and brainstorm with anyone, any potential reason someone would tell you no. Jot those down. Then I want you to start coming up with your responses to those no's. I want you to write it down. It doesn't have to be formal. You don't have to write it out like an essay. If you use bullet points, whatever format works for you is just fine. It's just running through the process of doing it. And I will guarantee you that will probably be one of the most important things that you can do in order to be properly prepared to be successful in fundraising for your business. So with that, I thank you, and I am very happy to answer some questions. Do we have questions today?
Sorry, I was muted, my bad. We do have some questions. So one of them is, how might I start networking during the pandemic? How do I meet people if we can't be face-to-face?
It's a great question. You know, normally when we think of networking, we think of shaking people's hands and talking to them and sitting down over a cup of coffee and having a conversation. But in the world we currently live in, that just isn't possible. So what can we do in the meantime? That doesn't mean we do nothing. That means we still need to get to work on networking. So, you know, much of what has happened in our world is that things have moved to an online format. Like this webinar is an online format. So I would suggest that you contact your SBDC office to see if they might have a list of potential webinars that could be helpful for you and your business. Attend those webinars, but it's not enough just to attend them. So after you do attend them, make it a goal to connect with either a presenter or an attendee who can be a part of your network. Social media is another great way that you could network right now, especially LinkedIn. And we're going to have a whole session on LinkedIn in September. So I would encourage you to come back for that. And even depending upon your business, you might think of other social media platforms such as Facebook or Instagram. So let's think about, you know, if you have a landscaping business, perhaps Facebook is a great place to start networking, because you can build your page, you can post before and after photos of different jobs. And then don't just let those people respond and make comments in a static environment. You need to interact with them, because especially if you decide you're going to do crowdfunding because your landscape company has come up with the latest and greatest landscaping tool, what a great time that you could get involved with crowdfunding if you've already built your social media network. So lots of opportunities.
Okay, another question is, what are good references for writing a business plan? Should I hire somebody to write it for me?
So there's lots of great references. That's the good thing about it. If I were you, I would start with my local SBDC office and see what resources they might have for helping you put your business plan together. Sit down when you have time and do a search on the internet. Of course, you need to be able to really filter the results that you get to make sure that they're credible sources, but there's a lot of great information out there. If you happen to be an alum of a university, or maybe a university is in your town or close by, don't be afraid to reach out to some of the business faculty there, because they certainly do have resources that they could help provide to you. As to whether or not you should hire someone to write your business plan for you, I'm going to say no. There's lots of people who will do it, consultants, companies, etc. But don't let writing your business plan intimidate you. Who knows your business better than you? So you should really, you know, sit down and critically think through every single aspect of your business, find a template, address everything that needs to be addressed, make sure that you're basing it on facts and data so that you can support your opinion. Now, if you feel like maybe you're not the very best writer in the world, or maybe your accounting skills aren't so great, so you need some help there, that's completely fine to go out and find that person, that consultant, who can help you polish the writing, who can help you find different areas where you might improve, or even help you with the financials. but I would suggest that it's very important for you to do it yourself the first round.
Another question is, how do accelerators or incubators fit within the fundraising cycle?
So those can provide great support at various progressive stages of a business. But my opinion, before you commit to an incubator or accelerator, you need to think about a few things. So for academic entrepreneurs, is the program the right fit for the company's needs? Is it a full commitment to the program's requirements? Is that going to work? There are also corporate sponsored and corporate run accelerators that may provide potential commercialization and investors even. They may also offer field-specific knowledge and mentorships. So the important thing to think about with those is it the right fit for each other?
Okay, another question is, what about nonprofit accelerators like Mass Challenge? They offer non-equity funding. At what point of my startup should I consider applying for something like that?
That's an incredible question, and that's a wonderful resource. So I would suggest in that particular instance that a startup or those companies that are seeking seed money would be the ones who would most benefit from a nonprofit accelerator. They, have classes, they have resources, they have different co-working spaces for entrepreneurs. So there's a lot of great benefits that come along with being associated. But again, just make sure that it's the correct fit. So if you're working with an accelerator who focuses entirely on STEM-based businesses, but again, as our example, you are wanting to start a landscaping business, well, that probably is not the right fit for you, even though it still is a great resource. So just consider those things.
Okay, and our last question is, how should I keep investors updated about the company's progress? A monthly newsletter or monthly meetings?
So that's a great question. And keeping people informed, there's a very fine line between keeping them informed and becoming annoying. And we don't ever want to become annoying with our investors. So I would suggest a quarterly newsletter would be more than sufficient. It doesn't need to be lengthy. It needs to be very short, to the point, so that it does not take a lot of time. We don't want to be obtrusive at all. I think a yearly meeting where they can actually, kind of kick the tires, if you say, is a wonderful thing. It gets them in your business if you have the capacity to hold it there. They get to talk to people who are in the business. But my best advice would be, once you get these investors together, ask them what they want. Ask them how they would like to be kept updated. That way you are doing what your target audience wants you to do.
Okay, and we have a Spanish question from a participant. So the question in Spanish is, ¿las reglas para recaudar fondos son las mismas en otros países? And the question in English is, are the rules for fundraising the same in different countries?
Well, I might say that the process might be very similar, but the rules are certainly going to vary. So there's different tax rules, there's different laws, and those do vary by country. So while it may seem that it makes a lot of sense, and it certainly might, for you to look at foreign markets to invest in your company, I would say to do so with caution. And I would also say to only do that under the guidance of a professional advisor.
Okay. Cada país tiene sus propias leyes y tiene sus propias leyes con las taxas y la economía en general. Si planeas en recaudar fondos o establecerte en otro país, no lo hagas solo. Contrata a alguien que sea profesional y que conozca la economía para que te pueda ayudar a recaudar y establecerte en ese país. también haz tu investigación sobre el país, infórmate de la cultura, la economía y también investiga si hay recursos que puedas usar en ese país para poder recaudar los fondos.
Okay, thank you so much, Rocio.
Mm-hmm.
And thank you to everyone for attending our webinar. Thank you to Kent, Rocio, and Sachez for helping us put this webinar together. We will see everybody on our next webinar, which will be on August 22nd, where we will be talking about how much to raise and when. The Zoom link for that will be on our WordPress website, and also on this website, you'll be able to find all of our other webinar sessions. And we will also be sending an Outlook invitation. In regard to the QR code on your screen, if you could please scan it with your phone, or you could also follow this link, and it will take you to the post survey, and you can complete it for credit. If you cannot complete this at the moment, you will also have access to this via our WordPress site. Thank you again, everyone, for your time, and have a nice day.
Thank you.